There's a 34-year-old software engineer in Austin who made $340,000 last year. And right now, he's losing money faster than someone working minimum wage at a gas station. In 2026, the rules changed, not officially. No one sent a memo. And the uncomfortable part, most people won't realize it until it's already happened. This isn't about market crashes or crypto scams. This is about math that stopped working the way it used to. And if you're making any of these three mistakes, the erosion has already begun. We're not even in 2023. The economic architecture of 2026 is fundamentally different, and most investment advice is still operating on the old blueprint. Corporate profit margins are compressing, and the asset prices that made sense 3 years ago now sitting on foundations that have shifted. Here's what that means in plain terms. Strategies that were mathematically sound in the 2010s can now produce negative real returns even when they look like they're reworking. But after inflation, after taxes, after the rising cost of everything his salary is supposed to cover, he's falling behind. Millions of people are following the same playbook, watching their account balances grow, and missing the fact that their purchasing power is shrinking. So let's break down the three mistakes. Not the obvious ones, the insidious ones. Don't put all your eggs in one basket. Spread your risk, own a little bit of everything. And for decades, it worked, because markets didn't move in lockstep. When stocks fell, bonds rose. When the US slowed down, emerging markets picked up. Stocks and bonds fall simultaneously. Real estate stumbles. Even gold, the supposed safe haven, has started moving in strange sympathy with risk assets. The diversification that used to protect you now just spreads your losses across more categories. The baseline. The thing every robo-advisor builds for you. In 2022, that portfolio lost about 18%. And now, in 2026, the structural reasons why bonds and stocks used to move in opposite directions have fundamentally changed. Why? Because both are now hypersensitive to the same thing, the cost of money. When rates rise, bonds fall, but stocks could still climb if growth stayed strong. That trade-off made sense. But now rates are neither low nor predictable, they're volatile. And that volatility whipsaws both sides of your portfolio at once. But the economic environment shifted underneath you, and now your prudent strategy is underperforming a simple index fund. Or worse, it's underperforming cash. And nobody tells you this, but holding cash in a 5% money market account has outperformed the average balance portfolio over the last 3 years. The mistake isn't diversification itself. It's assuming diversification still works the way it did. It's treating a 2015 strategy like it still applies in 2026, and the cost of that assumption is real money, compounding in the wrong direction. Mistake number 2. Chasing yield without questioning where it comes from. This one's subtle, and it's expensive. High-yield savings accounts, dividend stocks, REITs, bonds, structured products. But in 2026, yield isn't scarce anymore. It's everywhere, and that's precisely the problem. Let's take dividend stocks as an example. Sounds safe. Sounds smart. Here's what. Companies don't pay dividends out of generosity. And in 2026, a lot of companies paying high dividends are doing it because they're not growing, they're mature, or declining, or desperately trying to keep investors from selling. If a company is paying 5%, 6%, 7%, you need to ask why they're paying 4 times the market average. Sometimes it's because they're incredibly stable, but more often, it's because their stock price has fallen, and the yield only looks high because the denominator crashed. You're not getting paid for safety. You're getting paid for risk. Now let's talk about the newer stuff. High-yield savings accounts and money market funds paying north of 4%. Those sound bulletproof, and right now, they kind of are. But here's the trap. That rate isn't locked in. You're not building a long-term income stream. You're renting a temporarily high number. And if you've been sitting in cash for 2 years waiting for the right time to invest, you've already missed the compounding you can't get back. Private credit funds. Products that promise 7%, 8%, 10% with downside protection or limited risk. Read the fine print. Actually read it. You'll find fees you didn't know existed. Liquidity restrictions. And buried in the prospectus is the same truth. High yield means high risk, just repackaged so it doesn't feel like it. Here's the uncomfortable reality. In 2026, the risk-free rate, the rate you can get on a treasury bill, is sitting around 4.5%. It's compensation for taking on credit risk, duration risk, liquidity risk, or structural complexity you probably don't fully understand. And the mistake in taking those risks, sometimes they make sense. The mistake is believing you're not taking them. It's reaching for yield without asking what you're giving up in exchange. And when that trade goes wrong, it goes wrong all at once. This is the one that nobody wants to hear, because it's boring. Because it feels like something you deal with later. But taxes are the silent killer of investment returns, and in 2026, they're more expensive than ever. Except you didn't. If you held it for less than a year, that's a short-term capital gain. It's taxed as ordinary income. If you're in the 30% federal bracket, you just gave up $6.40 of that $20. Add state taxes, and you re-closer to $8. You didn't make $20. You made $12. And nobody talks about that until April. But here's where it gets worse. In 2026, we're sitting at the tail end of the Tax Cuts and Jobs Act provisions. A lot of the favorable rates and deductions that have been in place since 2018 are set to expire. Not hypothetically, automatically, and if you're planning your investments based on today's tax code, you're planning for a world that might not exist in 2 years. Here's a scenario most people miss. You've been contributing to a traditional 401k for 20 years. The balance looks great. But when you retire and start withdrawing, every dollar comes out as ordinary income. And if tax rates are higher than they are now, you didn't defer taxes, you just postponed paying a bigger bill. Meanwhile, Roth conversions, the strategy of paying taxes now to avoid them later, are sitting right there. But most people don't do them because it feels like writing a check for no reason. But over 30 years, the difference between paying 24% now and 35% later is enormous. And then there's the step up in basis, one of the last great tax loopholes. All the gains you made disappear for tax purposes. It's a massive advantage. Most people don't. They sell assets they should have held. They trigger gains they didn't need to trigger. They donate cash instead of appreciated stock. They rebalance without thinking about the tax bill they're creating. And every one of those decisions costs them thousands of dollars they'll never see again. Here's the thing that makes this mistake so brutal. You can be right about everything else and still lose if you ignore taxes. You can pick the right stocks, time the market perfectly, diversify intelligently, and still end up behind someone who just bought an index fund in a tax-advantaged account and did nothing. Because taxes compound in reverse. Every dollar you pay to the IRS is a dollar that can't compound for you. And over decades, that's not a small difference. It's the difference between retiring at 62 and working until 70. So here's where we are. The software engineer in Austin is still making money. His accounts are still growing. But the math underneath him has shifted, and by the time he notices, the gap will already be measured in years of work he can't get back. These 3 mistakes aren't dramatic. They don't blow up your account overnight. They erode, slowly, predictably. The question you have to ask yourself is this: if the rules changed and no one told you, how long would it take you to notice? Thanks for watching.